Welcome back to You and Your Money. We're discussing investments. My guest, Henry Biddlecombe. And if you'd like to email, my details will appear on the screen. Henry, a question for you, because there's a lot of talk about US listed companies. However, most of these companies that one invests in, it may be priced in dollars, but they're global companies. And if the dollar weakens further, their global earnings will increase. So I'd appreciate your comments.
Yeah, that's just a fact, Bryan. So I guess that's one of the perks of having a very diversified global business. And many of the big US listed companies are. Your earning streams are multi-currency. So if the dollar weakens, to your point, the dollar value of your profits actually goes up. So it's actually supportive of your stock price, which isn't always intuitive.
I'm now going to go to some of our emails. Mary in Durban says, how do you see tokenization and digital marketing infrastructure affecting portfolios over the next 10 to 15 years?
So tokenization is a really interesting concept on so many different levels. When it comes to transactions, stocks, funds, the way we invest, it stands to open up the ecosystem, which is great from a flexibility perspective. So, I can see one day as a retail investor, you being able to invest in any company anywhere in the world immediately. You might even be able to process those investments more than once on the same day. But does that necessarily have an impact on how I would be positioning your portfolio in the market and which companies I'd be choosing to buy? No, not really.
Henry, one of the reasons I never suggest a share, and you did say you liked Apple, but I want our viewers to know that's not a tip. I mean, Henry's done a lot of research. It's one of many companies, because the danger is we talk about a company here today and suddenly in the next month or two we see the results aren't achieving what we thought, and then we're talking to people about maybe not being in that company and you may not have heard it. So please be aware, one thing in You and Your Money, we never tip a share. Bongani in Santon said, what is the likelihood of a managed portfolio outperforming index funds over the next few years? I mean, managed portfolios have really battled to equal the S&P and NASDAQ earnings, and in some cases even the MSCI World.
So, Bryan, I think if we look at the nature of the indices now, for the S&P 500, for example, almost 40% of that index sits in the biggest 7 or 8 stocks. So those will obviously have an overbearing impact on the performance of that index. So there's by taking an active stance in just the top 7 or 8 stocks, an active manager's performance can seriously diverge from the index. And if your calls are correct, you can generate some serious alpha. So I think that the market right now is so well suited to an active manager, more so than it has been in the last 10 years.
Henry, let's talk, because everyone talks about equities, gilts, talks about property, and so on. But there is another strategy, there is a fifth strategy, and that is alternatives. And you run AIG Capital. Just share with us what you actually do in AIG Capital and what impact it could have on portfolios.
Bryan, so basically a hedge fund is designed to enhance the performance of a portfolio while simultaneously reducing its volatility. And when you blend it into the rest of your portfolio with a healthy allocation of, let's say, between 20 and 25%, you'll find that you have lower negative years and more consistent positive years. It is a relatively underdeveloped asset class in South Africa. People aren't as familiar with them as they are with other investments like unit trusts, and REITs and bonds, but that is changing. So if your viewers haven't looked into hedge funds yet, I would certainly encourage them to do so with the assistance of their financial advisor.
Yeah, I think it'd make a big difference, certainly in falling markets. I mean, then you may have a benefit, because in a hedge fund, maybe you're going not only long on the market, you may even be taking positions in a short situation. Okay, Penelope in Spring says, where do you find quality companies in South Africa that are reasonably priced to invest in?
So there are quite a few on the JSE. And interestingly, if you go and look at the relative performance of developed markets compared to emerging markets over the last 5 to 10 years, we're at almost an extreme point where emerging markets have underperformed quite dramatically. And I think we are due to see a significant rotation of capital away from developed markets into emerging markets. So by simply buying the JSE All Share Index, or a portfolio of quality South African businesses, the ones that foreigners like to buy, we won't get into specifics here. I think you stand to do quite well, even measured in dollars, over the next 5 years.
Henry, are you suggesting people bring back dollars?
Yeah, and in fact, we have been doing that. And you've done well, and I still think there's some legs left in the rand-dollar trade. But on top of that, we haven't really seen those powerful late-stage cycle flows into our stock market. And when that happens, our stocks can move dramatically. Think back to 2015 in the Ramaphoria trade. So I would definitely, if you're underweight South Africa, maybe consider going equal weight or even overweight.
Okay. Then Adrian in Santon says, do you think one needs to protect against a downturn global market other than liquidating equities? Are there any hedges that you can buy?
So firstly, mitigating risk by lowering your allocation to equities is always an excellent defense. But yes, there are definitely hedges that you can buy. You asked me earlier about hedge funds, Bryan. That's almost the best way to do it. Go and look at hedge funds that are uncorrelated or perhaps even slightly negatively correlated with the rest of the market. If you blend those into your portfolio, that will definitely dampen any drawdown that the market takes. I wouldn't really recommend getting into options. A lot of people like exploring put options and that kind of thing, because then you're also taking timing risk, and that's very difficult to get right.
Okay, then Dennis in Cape Town asks, please explain the rationale behind the falling shares when companies are happy with the results, but they do not achieve analyst expectations. So surely the analysts should have some accountability. Interesting one.
Well, that's what makes a market, isn't it? Markets are all about expectations and then reality mismatching those expectations. So you can't really hold analysts accountable for their opinion, because that's really what makes a market.
Although that's what drives the market. We talk about the fundamentals and we talk about sentiment.
Yeah, willing buyer, willing seller. But as the viewer points out, those moves can be violent. A company can produce a good result. Their profits can be up 20% on last year, but the stock can go down 30% because the market was expecting 30 or 40% profit growth. And that's particularly why I'm nervous about the US market at this point, because expectations are so high and valuations are so high that if these companies don't really perform, the stocks could easily fall, 15 to 25% from where they stand today.
Henry, over the last year, you've been quite negative and been concerned about some global share slowdown. It hasn't happened up to now. The last one we had was the 2nd of February when Trump announced the tariffs. Are you still feeling very negative and believe people maybe should be a little bit more conservative, either in AIG capital hedge funds or alternatively in cash? And then last one, what about bonds? Long question.
Right. So Bryan, you've got to look back to history. What do your returns from equities look like when valuations are sitting at 95th or 99th percentile levels? Historically, they're not good. They've typically been very, very low single digit for the next 10 years. And in some cases, they've been negative on an annualized basis for the next decade. Right now, valuations are at a relatively extreme point. The S&P 500 is expensive. The nature of those earnings that the market is pricing in are, in my opinion, relatively cyclical, even though some people don't think so. So I think it pays right now to be cautious. I don't think that you should be massively overweight equities. I don't think that you should be massively overweight US equities in particular. Now, on bonds, the negative correlation between bonds and equities over the last couple of years has broken down, and the two have become more and more correlated, actually. So bonds aren't necessarily the best first line of defense. Having said that, I do think that there's an opportunity at the longer end of the curve in the US. And also, again, talking about hedge funds, you could always go into market neutral strategies, which are designed to make absolute returns every month without taking any market risk. So those are two options.
Yeah, Henry, we've seen quite good returns from bonds. You've had the high rates of return as interest rates have fallen. You've had good capital returns from your bonds. Do you think bonds are now, just to clarify, do you think bonds now have reached that platform level where perhaps that's not going to give you much capital upside, but maybe pay a little bit more interest?
Yeah, it also depends on which bonds we're talking about. Is American bonds, is South African bonds?
South African bonds. I'm really talking about South African.
But yeah, I mean, obviously, going back a year and a half, South African bonds, I think were really cheap. Now, not so much, and that's for a number of reasons. But I think you're probably paying fair value for a South African bond today. So I think that's not necessarily a bad hiding place, actually, earning 8 or 9% in rands, with a rand that may well get stronger against the dollar. It's not a bad place to park.
Well, Henry, thanks, because we've now got through all our emails. We as advisors explain that the difference between income generation and growth investing is not about timing the market, but time in the market. That means if you have been invested in equity markets for many years going forward, your strategy still needs to be long-term in the market, as markets have no time memory. A lot of the financial press refers to the dangers of investing in markets, and they are right if you have a short-term time horizon. My advice, if we have volatility and your strategy is long-term, ride out any corrections. Henry, I'd like to thank you for joining me this evening. It's always good to chat to you, and also please be aware that our program tonight is to provide information and should not be construed as advice. Next week's program, we'll be dealing with estate planning. I'll also be dealing on Wednesday with a budget, and I hope many of you viewers will watch. I hope to unpack it for you. Thank you for watching, and good night.